In the simplest terms, tariffs are taxes on consumption, whether it's tariffs on imports that U.S. consumers buy or tariffs on exports that U.S. manufacturers produce. It makes those goods more costly, and the law of supply and demand, pure economics says the more costly on the supply curve, you're gonna drop down on the demand curve. So we think that the end game, which Larry Kudlow was just talking about in terms of trying to address unfair trade practices, being more equitable and fair in the overall trade platform. That's an admirable end game. It must be addressed. We just think tariffs are a blunt tool that are probably going to do more damage in the short term.
And in the short term, what are we seeing exactly? Is it more acute in ag? Is it more acute in steel? Can you be that granular yet?
Well, for us, we saw an immediate impact. You know, we buy some of our rail from Japan. It's got chemical structure and length that we don't get in the U.S. We actually pay a premium for that rail. And the first boat post the 25% steel tariffs cost us $6 million more. So, I mean, that was an immediate direct impact. And we've already seen steel prices in the U.S. go up something like 30% plus. So it's having an impact there. We can't say that it had an impact in the second quarter on our top line, which was pretty strong growth of 4% overall, and sound revenue growth at 8%. But I'm pretty confident if they stay in place over the medium and long term, we will see impacts.
Lance, wanted to ask you specifically about China. If we do see those threatened tariffs go through on $200 billion worth of goods, would that hurt you more than some of your competitors, given your exposure to the West Coast?
Yeah, the thing I'm most concerned about, there is a discrete impact on us if imports into the West Coast get impacted. The bigger concerns I have are on the U.S. economy and whether it disrupts consumption and industrial production. Those are two big drivers for us. And then the other thing I'm concerned about are supply chains. You know, as manufacturers, they're very sophisticated in today's economy. And once they set up supply chains, they continually drive productivity and efficiency through the chain. And if a tariff or a retaliatory mechanism force a manufacturer to change its supply chain, it'll get used to the new one. And the problem is, once that tariff or retaliatory mechanism goes away, they don't necessarily go back to the old supply chains, which means that could be a really bad thing for U.S. manufacturing and for us in terms of disruption in our current trade flow.
Fitch Ratings this morning has a note out on the impact of CapEx, and they cite specifically names that have been in the news, like Harley, GM, there's Toyota today, that's Alcoa cutting their EBITDA guide on this Section 232. Do you expect UNP to get more vocal about this and try to push back on policy?
You know, we've been out there pretty aggressively already, mostly in support of doing the right thing when it comes to trade in NAFTA. In NAFTA, that means modernizing, but staying in. And in global trade, that means making sure it's fair and equitable, but using the right tools to get there. And so I can't imagine picking that pace up any further. I am already deeply engaged. I would say when you mention capital, you know, our capital spending this year is going to be about $3.3 billion, and that's built on the promise of a robust U.S. economy and global trade, and that potentially could be impacted as you look into the future if those things get disrupted.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.